The Canada Revenue Agency has just announced significant new policies that will affect millions of Canadian seniors starting next month. If you're retired or planning to retire soon, you need to know about these changes right now, because they could mean thousands of extra dollars in your pocket, or potentially costly mistakes if you're not prepared. Hello everyone, and welcome back to the channel. Today, we're diving into one of the most important financial updates for Canadian seniors in years. The CRA has just revealed a comprehensive set of new policies that will transform how retirement income is taxed, reported, and managed. And these changes are set to take effect in March 2025. That's just weeks away, so it's crucial you understand exactly what's changing and how it might affect your financial situation. Before we get started, I want to ask, are you one of the millions of Canadian seniors who rely on pension income? Or perhaps you're planning your retirement and want to make sure you're making the best financial decisions. Either way, these new CRA policies will directly impact your financial future. So I encourage you to watch this entire video to ensure you don't miss any critical information. Let's begin with what's perhaps the most significant change: the new Seniors Enhanced Tax Credit. Starting in March 2025, the CRA is introducing an expanded tax credit system specifically designed to provide additional relief for seniors with moderate to low incomes. This enhanced credit will replace the current age amount tax credit, offering more substantial benefits to qualifying seniors. Under this new system, seniors aged 65 and over with annual incomes below $52,000 can claim up to $2,500 in non-refundable tax credits, an increase from the previous maximum of $1,259. For those with incomes between $52,000 and $75,000, the credit will be reduced gradually based on a sliding scale. What does this mean for you in practical terms? For many seniors living on fixed incomes, this could translate to several $100s in additional tax savings each year. Have you been struggling with rising costs of living while on a fixed income? This enhanced credit could provide meaningful relief, especially when combined with other benefits. Now, I know what you might be wondering. How do I qualify for this enhanced credit? And what do I need to do to claim it? The good news is that the CRA has simplified the qualification process. Unlike the previous system, which required seniors to complete a separate schedule, the new enhanced credit will be automatically calculated based on the information provided in your regular tax return. However, and this is important, you'll still need to ensure that all your income information is accurately reported, as the credit amount is directly tied to your total income. Another major change coming in March 2025 involves the way pension income splitting works. As many married or common law partner seniors know, pension income splitting has been a valuable tax planning strategy that allows the higher income spouse to allocate up to 50% of qualifying pension income to the lower income spouse, potentially resulting in significant tax savings for the couple as a whole. Under the new policies, the CRA is expanding the definition of what qualifies as eligible pension income for splitting purposes. Previously, individuals under 65 could only split income from certain employer-sponsored pension plans, while those 65 and older could also split income from RIFs, annuities, and other registered plans. Starting in March 2025, the eligible pension income definition will be expanded to include certain types of foreign pension income and income from specified annuity contracts for all seniors, regardless of age. Have you been receiving pension income from outside Canada? If so, this change could allow you to optimize your tax situation in ways that weren't previously possible. But there's a catch. Proper documentation will be essential, and the CRA has introduced stricter verification procedures for foreign pension income. Are you prepared to provide this documentation? It's something you'll want to discuss with your tax professional well before filing season. Speaking of documentation, the CRA is also implementing a new digital reporting system specifically for pension income. Starting in March 2025, all pension administrators will be required to use the enhanced digital reporting platform to issue T4A and T4 RIF slips to recipients. While this change primarily affects pension administrators rather than individual seniors, it's designed to improve accuracy and reduce processing times for seniors' tax returns. As a pension recipient, what does this mean for you? you can expect to receive your tax slips earlier in the tax season, allowing you more time to prepare your return. Additionally, the new digital system will include enhanced information about your pension payments, making it easier to understand exactly what types of income you're receiving and how they should be reported on your tax return. Have you struggled with understanding the various codes and amounts on your pension tax slips in the past? This new digital system aims to make that information clearer and more accessible, with detailed explanations provided directly on the digital forms. Now, let's talk about another significant change that could affect many seniors who continue to work past the traditional retirement age. The CRA is introducing a new senior workers benefit that will replace and enhance the existing working income tax benefit for seniors. This new benefit is designed specifically to encourage continued workforce participation among older Canadians while providing additional financial support. Under this new program, working seniors aged 65 and older with employment income between $5,000 and $35,000 can receive a refundable tax credit of up to $1,800 annually. This benefit will be gradually reduced for those with incomes above $35,000 and will be completely phased out for incomes exceeding $50,000. Are you one of the growing number of seniors who continue to work part-time or full-time during retirement? If so, this new benefit could provide a significant boost to your after-tax income. What makes this benefit particularly noteworthy is that it's designed to work in conjunction with existing benefits without creating clawbacks in other areas. In other words, receiving the senior workers benefit won't reduce your eligibility for the Guaranteed Income Supplement, GIS, or other income-tested benefits. This represents a significant improvement over the current system, where additional employment income can sometimes result in reduced benefits in other areas. Do you know how your current employment income affects your other retirement benefits? Many seniors don't realize that earning even modest amounts can trigger reductions in other areas of their retirement income. The new senior workers benefit aims to address this issue by providing a more integrated approach to senior income supports. Another area where the CRA is implementing significant changes involves Registered Retirement Income Funds, RIFs. As many of you know, RIFs are a common vehicle for converting retirement savings into retirement income, and they come with mandatory minimum withdrawal requirements that increase as you age. Starting in March 2025, the CRA is adjusting the RRIF minimum withdrawal rates to better reflect current life expectancies and economic conditions. The new rates will be lower than the current requirements for most age brackets, allowing seniors to preserve their retirement savings for longer periods if they choose to do so. For example, for a 71-year-old, the age when RRIF conversions become mandatory, the minimum withdrawal percentage will decrease from 5.28% to 4.70%. What does this mean for you? If you're currently drawing from a RRIF or will be converting your RRSP to a RRIF soon, these reduced withdrawal requirements could allow you to keep more of your money invested and growing tax deferred for longer. Have you been concerned about outliving your retirement savings? These new, lower withdrawal rates could help address that concern by allowing your RRIF to potentially last longer. But here's something important to consider. Just because you can withdraw less doesn't mean you should. Your optimal withdrawal strategy depends on your overall financial situation, including other income sources, tax brackets, and future needs. Have you worked with a financial advisor to determine your optimal withdrawal strategy? If not, these new rules might make this an excellent time to review your overall retirement income plan. The CRA is also introducing a new simplified reporting method for home support services for seniors. Currently, seniors who require assistance with daily living activities can claim the home accessibility tax credit for certain home modifications. But the process for claiming expenses related to ongoing support services has been complex.